That's when the exit became official. When a $2 billion Danish pension fund completed its total divestment from U.S. Treasuries, $100 million gone, sold, exited. But that's not the story. The story is what happened 12 hours later when Sweden's largest pension fund revealed it had quietly dumped $8.8 billion in treasuries. Not announced, not telegraphed, just sold, over 12 months in silence. And suddenly the $100 million from Denmark wasn't symbolic anymore. It was precedent. Because when you add Denmark's $100 million to Sweden's $8.8 billion, when you include the other Danish funds that sold quietly, when you realize this is just the beginning, you're not looking at isolated incidents. You're looking at coordinated exit, smart money leaving, the canary dying in the coal mine, and the question isn't whether more will follow. The question is whether you'll still be holding U.S. assets when they do. This is the systemic revelation. This is the four-stage capital flight pattern. And we just entered stage 2, the quiet exit. When professional money managers, people who get fired for underperformance, people legally obligated to maximize returns, conclude that U.S. Treasuries, the safest asset in the world for 80 years, are no longer safe. And they sell. Not because of politics, not because of Greenland, not because of Trump, but because the math stopped working. Because $38.56 trillion in debt at rising interest rates equals eventual default. And smart money doesn't wait for eventually. It exits early, quietly, before the crowd realizes, before the panic, before the collapse, and that exit just began. February 1st, 2026. Let me show you the pattern. Stage 1, the realization. When professional investors see what's coming, every capital flight begins the same way. The professional money, the pension funds, the sovereign wealth managers, the people paid to see problems early run the numbers. And the numbers don't work. The debt is too high, the deficit's too persistent, the interest payments too crushing, and they realize often years before the public that the asset they're holding will eventually fail. Not might, will. And once that realization hits, once the math becomes undeniable, stage 1 is complete. The decision to exit is made. All that remains is timing. And we just saw the timing. February 1st, when multiple Nordic pension funds moved simultaneously, not coordinated officially, but aligned mentally, because they all ran the same numbers and reached the same conclusion. Start with academic or pension, $24.9 billion in assets under management, Danish pension fund for academics, teachers, professors, researchers, people who value data evidence proof. And on January 20th, 2026, their chief investment officer, Anders Schelde, made an announcement, quote, "The U.S. is basically not a good credit, and long-term the U.S. government finances are not sustainable." Read that again. The U.S. is basically not a good credit. That's a pension fund fiduciary legally obligated to invest prudently, publicly declaring that United States Treasury bonds are not creditworthy, not risky, not concerning, not credit-worthy. And he didn't stop there. Quote, "We decided that we can find alternatives." Unquote, alternatives. 2 U.S. Treasuries, the benchmark safe haven asset for the global financial system, the risk-free rate, the foundation of every portfolio allocation model, and a $25 billion fund with a legal duty to its members just said, "We found something safer." The fund held $100 million in treasuries at year-end 2025. And by February 1st, 2026, 12 days ago, that position was zero, completely exited, sold to cash, dollars, and short-dated agency debt. No treasuries, none. Because, as Schelde explained, quote, "The decision is rooted in the poor U.S. government finances, which has led us to assess that we need to make an effort to find an alternative way to handle our liquidity and risk management." Unquote, poor government finances from a pension fund that has used treasuries for liquidity management for decades. That's not political, that's mathematical. When debt hits 38 trillion and interest consumes 1 trillion annually and deficits run 2 trillion per year permanently, the math breaks and professional investors exit. But academic retention wasn't alone. That same week, Lerna's Pension, another Danish fund, disclosed it had slashed treasury exposure months earlier before the Greenland crisis, before Trump's tariff threats, just quietly sold because, quote, "concerns over U.S. debt sustainability and threats to the Federal Reserve's independence," unquote, Fed independence. Professional investors watching Trump criminally investigate Jerome Powell concluded the Fed might lose independence, might become politically controlled, might print unlimited money to finance deficits. And they sold before that happened, before the announcement, before the crisis. That's smart money anticipating exiting early. Then PFA Pension disclosed $129 billion in assets. Denmark's largest pension fund, more than 5 times the size of academic or pension, and they sold too. The announcement came later, but the sales happened throughout 2025. Quote, "sold down U.S. Treasuries in 2025, I increased currency hedging due to the U.S. unilateral trade policies and repeated challenges from President Trump to the nation's central bank. There's the pattern. Multiple independent funds, different sizes, different mandates, different timelines, all reaching the same conclusion. U.S. fiscal sustainability is questionable. Fed independence is threatened, and we need to exit. And then the bomb dropped. January 21st, Sweden's Electa, 143 billion in assets under management, Sweden's largest private pension fund, managing retirement savings for 2.8 million Swedes and 37,000 companies, revealed they had sold the majority of their U.S. Treasury holdings. Not all, the majority. How much? Between 7.7 and 8.8 billion dollars, 8.8 billion sold quietly over 12 months starting early 2025. No announcement, no press release, no warning, just systematic selling month after month until most of it was gone. Chief Investment Officer Pablo Bernango explained, quote, "This is connected to the decreased predictability of U.S. policy in combination with large budget deficits and a growing national debt." Unquote, decreased predictability, professional language for we can't forecast what happens next, can't model the risk, can't price the uncertainty, so we exit. And when a $143 billion fund managing pensions for millions can't price U.S. Treasury risk anymore, that's not a political statement. That's a fiduciary responsibility. Get out before you know what's coming, because what's coming isn't good. Add it up. Academic or pension, 100 million. Lewis pension undisclosed but significant. PFA pension, 129 billion fund reducing exposure. Electa, 8.8 billion confirmed sold. Total disclosed Nordic investment at minimum 9 billion in confirmed treasury sales. And these are just the funds that went public. How many sold quietly? How many reduced exposure without disclosure? How many shifted from overweight to neutral to underweight without telling anyone? Because pension funds don't announce every trade. They announce when legally required or strategically beneficial. And if 9 billion was worth announcing, how much wasn't? Denmark as a country held 9.88 billion in U.S. Treasuries as of November 2025. Down from 18 billion in 2021, cut in half in 4 years. That's not market fluctuation. That's systematic reduction, strategic exit. And it's accelerating because February 1st was just the visible tip, the disclosed portion, the part they had to reveal beneath that quiet selling, continuous, relentless, professional. That's stage one, the realization. When smart money concludes, the asset will fail eventually, and begins the exit. Not loud, not panicked, calculated, systematic, quiet, until it's too late for everyone else. Verified. Stage two, the justification, when they explain why they're right. Stage two is when the money that exited explains publicly why they left. Not to brag, not to panic others, to justify to their own stakeholders, to boards of directors, to pension beneficiaries, to regulators, to anyone asking why did you sell the safest asset on earth? And the answers reveal the depth of the problem. Because these aren't random retail investors panic selling on Twitter rumors. These are PhD economists, quantitative analysts, risk managers, people who spent 30 years building careers on avoiding mistakes. And they're all saying the same thing. The United States is not a good credit anymore. And here's why. Start with the fiscal numbers. And Shelda from Academic Repension was blunt. Quote, "The U.S. is basically not a good credit, and long-term the U.S. government finances are not sustainable. What does unsustainable mean specifically? Debt to GDP over 100%, 38.56 trillion in total debt, growing 6.43 billion per day, 267 million per hour, 4.46 million per minute, and accelerating. Because the deficit isn't shrinking, it's structural, permanent, 2 trillion annually forever, until it can't be financed. And when professional investors calculate the timeline until it can't be financed, they get a number, maybe 5 years, maybe 10, but finite, countable, real, and they exit before that date arrives. Then there's interest costs, $1 trillion annually in 2026, the fastest growing line item in the federal budget, bigger than defense, bigger than Medicare, and compounding. Because when you borrow $574 billion per quarter, just announced February 4th for Q1 2026, and rates are 3.5 to 3.75%, that's $21 billion in additional annual interest just from one quarter's borrowing. Multiply by 4 quarters, $84 billion in added interest annually. And that assumes rates don't rise, but they will. Because when foreign buyers exit, when pension funds sell, when demand drops, yields must rise to attract buyers. And when yields rise on 38 trillion, interest explodes exponentially. Here's the math these pension funds ran. Current debt 38 trillion, current average rate 3.8%, current annual interest 1.44 trillion. If yields rise to 5%, which is where they go when foreign creditors exit, interest becomes 1.9 trillion. If yields hit 6%, Interest is 2.28 trillion. If 7%, 2.66 trillion. And 7% isn't crisis level. Britain hit it in 2022. Italy routinely trades there. When confidence breaks, when foreign holders dump, 7% is the floor, not the ceiling. And at 7% on 40 trillion, because debt will be there by late 2026, interest alone consumes 3 trillion annually. More than all personal income taxes collected, more than all corporate taxes. The entire federal revenue base doesn't cover interest, let alone anything else. That's mathematical default, not eventual, imminent. And pension fund managers see it, calculate it, and exit before it happens. But it's not just fiscal math, it's Fed independence. Multiple Nordic funds cited this explicitly. Lauren's pension, quote, threats to the Federal Reserve's independence. PFA pension, quote, repeated challenges from President Trump to the nation's central bank. What are they seeing? Jerome Powell criminally investigated by the DOJ for testimony about a building renovation. A pretext. Everyone knows it. The real reason Powell won't cut rates fast enough to reduce debt servicing costs, won't monetize debt aggressively enough to keep Treasury auctions functioning, won't subordinate monetary policy to fiscal needs, and Trump is forcing him out. Nominated Kevin Warsh to replace him, and once Warsh is confirmed, once Trump's Fed chair is in place, the Fed becomes a subsidiary, an arm of the Treasury, printing whatever is needed to fund whatever is spent. That's not independence. That's subordination. And when central banks lose independence, when monetary policy becomes fiscal policy, currencies collapse always, without exception. Argentina, Turkey, Venezuela, Zimbabwe, every single time. And pension fund managers have seen this movie, know how it ends, and exit before the final act. Then there's geopolitical unpredictability. Pablo Bernano from Electa. Quote, decreased predictability of U.S. policy. Unpredictability isn't risk. Risk can be modeled. Priced, hedged, unpredictability can't. When Trump threatens to annex Greenland by force, when he tariffs NATO allies for not selling territory, when he criminally investigates the Fed chair, when policy shifts based on truth social posts rather than strategic planning, you can't model that, can't forecast it, can't price the probability distribution. So you exit because unpredictable environments generate tail risk events, black swans, and pension funds managing retirement savings for millions can't afford black swans, can't risk a sovereign default, a currency crisis, a confiscation event, so they reduce exposure systematically until it's minimal or zero. And here's what makes this different from past scares. These funds didn't sell because of politics. Sheldon explicitly said, quote, it is not directly related to the ongoing rift between the US and Europe. But of course, that didn't make it more difficult to take the decision, unquote, translation. We were going to sell anyway. The fiscal math demanded it. The Greenland crisis just removed any hesitation, made the decision easier, confirmed what we already knew. The U.S. is not a reliable partner, not a safe haven, not a good credit, and we need out. But here's the most damning justification. These funds aren't exiting U.S. assets entirely, just treasuries. Academic pensions, Sheldon, quote, we will probably never be able to withdraw completely from the American market, as it has historically been a major growth driver in terms of returns, unquote. They're keeping U.S. stocks, U.S. corporate bonds, U.S. real estate, U.S. equities, just selling U.S. government debt. Because the problem isn't America, the problem is the U.S. government, the fiscal situation, the debt load, the political dysfunction, the Fed independence crisis. And when professional investors separate American private sector assets from American government assets, when they conclude the companies are fine, but the sovereign is failing, that's the most precise signal possible. It's not anti-American, it's anti-insolvency. And the U.S. government is insolvent. The pension funds know it, calculated it, and are exiting before the market figures it out. That's stage 2, the justification. When smart money explains why they left, and the reasons are mathematical, fiscal, monetary, geopolitical, all converging, all pointing the same direction, exit now before it's too late. Because once stage 3 begins, once the crowd realizes what's happening, and the exit door becomes a stampede and nobody gets out, which brings us to now undeniable. Stage 3, the acceleration, when the exit becomes contagious. Stage 3 is when the quiet exit becomes visible. When one fund's disclosure triggers others, when the realization spreads from smart money to institutional money to retail money, when the trickle becomes a flood, and we're watching it happen real time. February 12, 2026. Because the Nordic disclosures weren't isolated incidents. They were the trigger, the signal, the confirmation that everyone else was waiting for. And now the question spreading through every pension board, every sovereign wealth fund, every central bank reserve manager globally is simple. If Denmark and Sweden are selling, what do they know that we don't? And once that question is asked, Once fiduciaries start questioning, the selling accelerates because nobody wants to be the last one out. Look at the timeline. January 20th, academic repention announces exit 100 million. Media reports it. Treasury Secretary Scott Bessent dismisses it. Quote, Denmark's investment in U.S. Treasury bonds like Denmark itself is irrelevant. That is less than 100 million. They've been selling treasuries for years. I'm not concerned at all. Unquote. Irrelevant, not concerned. Classic denial. Then January 21st, 12 hours later, Elector reveals 8.88 billion in sales, 88 times larger than Denmark. Suddenly irrelevant, becomes significant. Not concerned, becomes concerned. And Bent goes quiet. But the contagion doesn't stop there, because once two major Nordic funds disclose, others face pressure. Boards ask questions. Why didn't we exit? Did we analyze U.S. fiscal sustainability? Are we overexposed? And fund managers scramble to review, to model, to justify. And many reach the same conclusion the Nordic funds did. We need to reduce, not eliminate, reduce. Get from overweight to neutral, from neutral to underweight, from underweight to minimal. And that reduction, when applied across hundreds of billions in European pension assets, becomes tens of billions in selling of quiet, systematic, but relentless. Denmark as a country total pension assets, 782 billion as of March 2025. 26% invested in U.S. assets, that's 203 billion. But most is equities and corporate bonds, only 9.88 billion in treasuries as of November 2025, down from 18 billion in 2021. That's a 45% reduction in 4 years. 8 billion in selling just from Denmark, a country with 5.8 million people. Now extrapolate. Sweden, Norway, Finland, Netherlands, Germany, France, Italy, Spain, all running similar analyses, all reaching similar conclusions, all reducing exposure. Maybe not announcing, maybe not disclosing, but selling. Because once the smart money validates the thesis publicly, once the fiduciary justification exists, everyone else follows. And it's not just pensions. Denmark's Defense Intelligence Service issued a report December 2025. First time ever describing America as a potential security risk. Quote, U.S. willingness to use its economic and technological strength as a tool of power, also toward allies and partners. Unquote. That's a NATO ally, a founding member of the Western Alliance, officially classifying the United States as a security risk. Not Russia, not China, America. And when defense intelligence agencies start warning about economic weaponization, central banks listen. Sovereign wealth funds listen and they adjust. Reduce dollar exposure, increase hedging, diversify reserves quietly, professionally before the crisis. Europe collectively holds $8 trillion in U.S. assets, bonds, and equities, $3.66 trillion in treasuries alone. That's 33% of all foreign-held treasuries, the largest foreign creditor bloc, bigger than Japan, bigger than China, bigger than everyone else combined. And if even 5% of that $8 trillion shifts, that's $400 billion in selling. If 10%, $800 billion, and treasury markets trade roughly $650 billion per day on average. So $800 billion over 3 months is $3 billion per day. Noticeable. Not catastrophic, but noticeable. Enough to push yields up 20, 30 basis points. Enough to increase borrowing costs. Enough to accelerate the debt spiral. But here's what makes stage 3 lethal. It's not the selling itself, it's the perception. Because markets don't crash on fundamentals, they crash on narratives. And the narrative shifting globally is this. U.S. treasuries are no longer risk-free. The safe haven is no longer safe. The asset you hide in during crisis is now the crisis. And once that narrative takes hold, once institutional investors start treating treasuries as risky rather than risk-free, the entire portfolio construction framework collapses. Because every model, every allocation, every risk calculation assumes treasuries are the baseline, the zero-risk asset. And if that assumption is false, if treasuries carry default risk, inflation risk, political risk, then every other asset needs repricing too. Stocks higher risk than modeled. Corporate bonds higher risk, real estate higher risk because the foundation moved. And when foundations move, buildings collapse. And we're seeing it, the 10-year Treasury yield, 4.29% as of February 11th, up from 3.6% in September 2025, 70 basis points in 5 months. Not because growth accelerated, not because inflation surged, but because demand weakened, because foreign buyers reduced, because pension funds exited. And as yields rise, as borrowing costs increase, the fiscal math gets worse, which makes more funds sell, which pushes yields higher, which worsens the math. Doom loop, self-reinforcing, accelerating, that's stage 3. When the exit becomes contagious, when one sale triggers another, when the trickle becomes a flood, and we're in it right now, February 12th, 2026. But the real acceleration hasn't even started yet because the Nordic funds went public, disclosed, announced, most won't. Most will sell quietly, reduce positions over quarters, years, without ever telling anyone. And you'll only know what happened when the data comes out. When Treasury International Capital reports show European holdings down another 200 billion. When central bank reserve composition shifts. When the dollar share of global reserves drops from 59 to 57 to 55% slowly, then suddenly. And by the time it's obvious, by the time everyone sees it, it's too late to exit because stage 4 has begun. Check. Stage 4, the collapse. When the dollar loses reserve status. Stage 4 is endgame. When the selling overwhelms the buying. When Treasury auctions start to fail. When yields spike past 5, 6, 7%. When the Federal Reserve becomes buyer of last resort. When money printing accelerates. When inflation reignites. When the dollar crashes. When reserve currency status dies. Not over years, over quarters. Because modern capital moves at digital speed, and when 8 trillion in European assets starts rotating out of dollars simultaneously, when Asia joins, when BRICS coordinate, when central banks dump reserves, the cascade is unstoppable. And that's not speculation, that's pattern recognition. Because we've seen this before. Britain, 1945 to 1967, sterling went from 81% of global reserves to negligible, from $5 per pound to $1, from empire currency to irrelevant in 22 years. But the actual collapse 3 years, 1964, crisis 1965 intensifies, 1966, multiple bailouts. November 18th, 1967 devaluation, 14% overnight reserve status over America's collapse will be faster because debt levels are higher, because the fall is farther, because markets move faster, and the mechanics will look exactly like this. Foreign treasury selling accelerates. Nordic pensions exit, then German funds, French funds, Italian funds, UK funds, then sovereign wealth funds, Norway's 2 trillion, UAE's trillion, Singapore's hundreds of billions, then central banks. Japan needs liquidity for domestic fiscal stimulus. China retaliates for Taiwan or trade policy. BRICS coordinate derization. Selling reaches critical mass, 200 billion per month, 300 billion, 500 billion. Treasury auctions start failing. The April 10-year note auction tries to sell 42 billion, but bid-to-cover ratio drops to 1.2. Weak demand. Yields spike to 5.5% just to clear. Then the May auction fails worse. Yields hit 6%, then 6.5%, and the Fed panics. Emergency FOMC meeting unscheduled. Announces 200 billion in Treasury purchases immediate to stabilize markets. But that's not stabilization. That's monetization. Debt monetization, and markets know it, see it, punish it. The dollar crashes down 5% in one day, down 10% in 1 week. Gold spikes to 4,000 per ounce, then 4,500, then 5,000. Import prices surge. Gas goes from $4 to $6. Food prices up 20%. Inflation jumps from 3% to 5% in 1 month, then 7, then 9. And the Fed faces impossible choice. Keep monetizing and accept hyperinflation, or stop monetizing and accept sovereign default. They choose monetization, always do. Print money, lots of it. Balance sheet goes from 7 trillion to 10 trillion in 3 months, then 15 trillion, then 20. Helicopter money, universal basic income, whatever justification works. But it's all the same thing. Currency debasement, Zimbabwe, Argentina, every failed currency in history, and reserve status transfers not to one currency, to multiple. The euro if Europe stays united, the yuan if China maintains discipline, gold if nothing else works, maybe a multipolar system, maybe digital currencies, maybe IMF special drawing rights. Doesn't matter. The dollar's privilege is gone, the exorbitant privilege, the ability to print the world's reserve currency, to run trillion-dollar deficits permanently, to borrow without limit, to consume more than produced. Gone, and once gone never returns. No country in history regained reserve status once lost. Spain didn't. Portugal didn't. Holland didn't. Britain didn't. The baton passes once, and the country that loses it enters structural decline, permanent, irreversible. Because without reserve currency privilege, without the ability to export inflation, without foreign creditors financing deficits at negative real rates, the U.S. must balance its budget, must cut spending, must raise taxes, must shrink the military, must reduce entitlements, must accept lower living standards. That's the price of losing reserve status. That's what Britain learned, and what America will learn soon. But you don't have to wait for stage 4 to protect yourself. You have a window right now. February 12, 2026, before the acceleration intensifies, before the contagion spreads, before the panic begins because smart money already exited, 9 billion confirmed, probably 50 billion quietly. And they're telling you what's coming. not through predictions, through actions. When pension funds managing retirement savings for millions sell U.S. Treasuries completely, when they publicly declare the U.S. is not a good credit, when they explain long-term government finances are not sustainable, believe them because they're right. The math proves it, and you can either exit now before everyone else realizes or stay and lose 30, 40, 50% when stage 4 hits. Your choice. So what do? 6 steps. Let's go through them. 1. Accept the treasuries are no longer risk-free. This is the hardest step psychologically because for your entire investing life, treasuries were the safe haven, the benchmark, the zero-risk asset. But that's over. When Nordic pension funds with fiduciary duties exit completely, when they publicly state U.S. government finances are unsustainable, the safe haven is no longer safe. Reprogram your mental model. Treasuries now carry risk, default risk, inflation risk, currency risk, political risk. Treat them accordingly. 2. Reduce treasury exposure systematically. If you hold treasury bonds, funds, ETFs, start reducing, not panic selling, systematic reduction, 10% per month, 20% per quarter, whatever fits your situation. Move to shorter duration bills instead of bonds, 1 year instead of 10-year, floating rate instead of fixed. And consider alternatives, corporate bonds, municipal bonds. Tips. If you believe official inflation data, international bonds, diversify away from sovereign exposure. 3. Increase gold allocation significantly. The Nordic funds are rotating out of treasuries into what? Gold, among other things, because gold is the only asset with zero counterparty risk. Can't be printed, can't be defaulted on, can't be confiscated easily. It's real, final, permanent. Central banks globally are accumulating. China, Russia, India, Turkey, Poland. If central banks are buying and pension funds are buying, you should be too. 10 to 20% of investable assets, maybe more if deeply concerned. Physical gold coins or bars, allocated storage, not ETFs, not paper gold, real metal you can touch. 4. Diversify currency exposure internationally. If the dollar is losing reserve status, if European funds are reducing dollar holdings, don't be concentrated in dollars. Diversify euro, Swiss franc, Singapore dollar, Norwegian coin, Canadian dollar, not abandoning dollars entirely, but reducing concentration, because when the dollar devalues 20, 30, 40%, diversified currency holdings preserve value. And you can implement this through international stocks, foreign bonds, currency ETFs, foreign real estate, anything that generates returns outside the dollar system. 5. Increase hard asset allocation. Real estate, commodities, infrastructure, energy, farmland, timber, water rights, things with intrinsic value, things that produce income or goods, because when currencies devalue, when paper money loses purchasing power, hard assets maintain value. A barrel of oil is still a barrel. Bushel of wheat is still a bushel. A rental property still generates rent. Hard assets hedge inflation, hedge debasement, hedge currency collapse, include them. 6. Prepare mentally for dollar reset. This is coming. Not maybe, not eventually coming. Pension fund managers see it, calculated it, exited ahead of it. And when it arrives, when treasury auctions fail, when the Fed monetizes, when the dollar crashes, when reserve status dies, most people will panic. Sell at bottoms, buy at tops. Make emotional decisions that destroy wealth. Don't be most people. Understand the reset is inevitable. Accept it. Position for it. And when it happens, when markets crash and media screams and politicians promise solutions they can't deliver, stay calm. Execute your plan. Because the reset is a wealth transfer from the unprepared to the positioned, from those holding dying assets to those holding real assets. And if you're positioned now before stage 4, you're on the right side of the transfer. The exit began February 1st, 2026. Academic Pension completed its total divestment. Elected disclosed $8.8 billion in sales. Multiple other Nordic funds reduced exposure. $9 billion confirmed, probably $50 billion total. And they're not done. This is the beginning, the quiet phase, when smart money exits before the crowd realizes what's happening, before the panic, before the collapse, and they're giving you a gift, a warning, a head start. When pension funds managing hundreds of billions publicly declare the U.S. is not a good credit, when they exit treasuries completely, when they explain government finances are unsustainable, they're showing you what's coming, not predicting, proving through actions. Europe holds $8 trillion in U.S. assets, $3.6 trillion in treasuries. If 5% rotates out, that's $400 billion in selling. If 10%, $800 billion. If 20%, $1.6 trillion. And it won't stop at Europe. Asia will follow. BRICS will follow. Central banks will follow. Because once the smart money validates the thesis publicly, everyone else must act, must justify to their boards why they're still holding, must explain why they're not following the professionals. And most won't have good answers, so they'll sell quietly, systematically, relentlessly. And by the time it's obvious to everyone, by the time Bloomberg headlines scream European exodus, by the time Treasury yields hit 7%, it's too late. The exit door is jammed. Or is